I'm Jake Musson, and I run some of the dairy farm monitor projects and dairy base from Dairy Australia's end. So I work quite closely with Sheena on the New South Wales Farm Monitor project, and today I'm going to just be looking at some of the insights and profit drivers of various systems over the history of the Farm Monitor project in New South Wales. Because I think, when you're tackling something as complex as farm systems, it is important to be as informed as possible, which is why I'm going to be delving into that data today. So first of all, I want to say dairy farmers are some of the best risk managers out there. And I think these images would resonate with everyone in the room today. We've had in the last 5 years drought, bushfires, COVID-19, which has been particularly nasty for anyone in Victoria, being locked down for around 6 months. And we've had some pretty severe fluctuations in milk price and feed costs as well over the years. But I think what keeps everyone going is that the grass is always greener over the other side, and there are those years where a lot of money is made and wealth is compounded at a rate that really you'd struggle to get anywhere else on the market. So this article caught my attention in 2015 when the milk price crashed and we had the clawback saga. The article was cost control will be key to surviving tough times, but who would have thought that cost control would have been stretched out for over 5 long years? Now, cutting costs in 1 year is hard, but cutting costs over multiple years is almost impossible. Repairs and maintenance to tracks and machinery can be delayed, reinvestment can be put on hold, imputed hours can be increased, but none of these things are actually sustainable over a long period of time, like the 5 years that we've just had. So it became less about cutting costs and more about a system adjustment. So we want to find ways to increase efficiencies whilst under pressure, to reduce costs over time without adversely affecting that milk production, and to maximise that margin. And what's the best way to do this? Well, we want to look at some of the profit drivers that we've pulled out of the Dairy Farm Monitor project for a start. And the first one I'm going to be looking at is cost of production. Now, this graph shows cost of production per kilogram milk solids on the bottom axis versus our earnings before interest and tax, or EBIT, over the left-hand side. And this is for all of New South Wales over the entire project since it began in 2011-12. Now, that little red box that I've highlighted shows the relationship strength, and that's quite strong. So around 50% of the variation in a farmer's EBIT can be down or put down to the variation in cost of production. So this should be fairly obvious because we do have poor conditions in some years which will inflate costs and will reduce margin and therefore profit. But when we look at this same graph in any individual year, the same trend is demonstrated. And this is the case generally in any region that you look at, whether it's Western Australia, Tasmania, New South Wales, as we've just put, that relationship of cost of production and EBIT is relevant. So it doesn't necessarily mean you're going to be much more profitable if you've got a lower cost of production, but it does give you a far greater chance. And this graph shows that it's not just seasonal conditions between years that are affecting this relationship. It's the differences between the farm systems, the farm businesses that are actually affecting this relationship with cost of production and our profit. So the next step is to break down cost of production to see where some of the components of this are driving the relationship, basically where the big winners come from. So the first component I'm going to look at is overhead costs. And similar to before, we've got our overhead costs per kilogram milk solids for New South Wales versus our EBITs on the left-hand side. Now, the relationship is lesser, but it's still around that sort of 22% of our EBIT is due to the variation in overhead costs. And for every dollar increase in overheads, EBIT on average reduces around 67 cents. So this is fairly significant. And again, I think this highlights that in this green section, it doesn't necessarily mean you're going to be more profitable if you have a low overhead costs, but it certainly gives the businesses a lot more opportunity to maximize their profit. Now can you still see my slide? Because that's just gone off, Nico.
Yeah, we can see it, but we can see, yep, there it goes back.
Yeah, no worries at all. So basically running at that end of the,
Jake,
yep.
there it swapped back to kind of your PowerPoint.
Yeah, I don't know what's going on there, but I'll just get off that. There we go. I'm assuming that's back to it again.
Yep.
Perfect. So it gives you a far greater margin if the business is run efficiently and overheads are reduced. And that's also going to help with business shocks along the way, such as the ones we've just had, like drought or milk price variation, because there's more flexibility on the margin and farmers have more room for feed prices to increase. Now, the other takeaway from this graph is high overheads operating on this higher end of the scale means attaining a profitable business is virtually impossible for these farms. So that was a real takeaway for me. Now, the second component, or the second big winner that we can look at out of cost of production, is going to be feed costs. Now, similar to the last two graphs, this shows feed costs per kilogram milk solids on the bottom axis for New South Wales, compared to our EBIT per kilogram milk solids on the left-hand side. And you can see that this is another one of these primary profit drivers that it is important to get right, and that there is quite a strong relationship, around 28% of EBIT being due to feed costs. Now, again, it should be obvious that those poor years will really inflate this, but if we take out single years, the same trend is demonstrated. Those managing to reduce feed costs are more profitable. But what I want to stress is that doesn't mean cheap feed is more profitable, because it is in terms of dollars per kilogram milk solids produced. And I always say underfeeding cows is the quickest way to increase your feed costs per kilogram milk solids produced, because you stop producing milk efficiently. I like to think of it as trying to feed James Tedesco a buffet of Maccas every week and still expecting him to perform in the next state of origin game. You just can't do that to an elite athlete. So it's about setting up a business that can reduce their feed costs in the most effective and efficient way possible for the resources that they have. And this brings me to that system discussion. We now know the key profit drivers. So we've got that cost of production, those overheads, and those feed costs. And we know that it's important to get each one of those three right. But which system does it best? Or does it depend? So let's look at the data to see what our profit drivers show for New South Wales. And the first one I'm going to look at is graze systems. Now, I've split in this table the years up into two groups. So we've got our average year of 2012 to 2017 and our drought years, which needed to be separated in 2018 to 20, just because of how different they were to the average. Now you can see in both of these years, graze feed was by far the cheapest form of feed, by around $100 per tonne dry matter. And the other real take home for me was that fodder purchase increased at a far greater rate than our conserved all graze feed, which I think is important as well. So from this graph, it should be fairly obvious that systems that maximise graze pasture should be more profitable in reality. So they've got the lowest cost dollars per tonne dry matter. We know that historically they are profitable pre-2000s. And I've listed just a couple of studies from around that show that that graze pasture is a key profit driver. And some of those are from Ireland, New Zealand. We've got our own in Australia as well. But when I look at New South Wales data, we actually don't see that relationship as strongly as we would expect. So I've pulled out this for southern New South Wales, because northern New South Wales the relationship is almost non-existent altogether. And this just shows the graze percentage of the diet on the bottom axis of the farm versus our EBIT on the left-hand side. Now, it's around 10, so around 10% of that variation in EBIT is due to that graze portion of the diet in both our average years in green and our drought years for the last 3 years in red. And again, Northern New South Wales, this relationship was almost non-existent. So one of the key takeaways for me was that the graze portion of the diet had actually reduced around 10 to 15% for the farm monitor group as a whole. And I think this is really interesting because it shows that it's not just about the differences in systems, it's also the whole group has reduced their grazing due to those uneconomical conditions of inflated water costs or poor seasonal conditions. So we start to see more influence of seasonal variation rather than system variation influencing this relationship. Now, I think this graph really shows it all. Unfortunately, grazing is not always in our control. And while low-cost grazing is obviously an extremely economical way to produce milk, we are highly constrained by water markets and seasonal conditions such as the one depicted on this graph. So we can conclude that grazing is a great academic way to maximise profit. And if you've got the resource to do this, it is fantastic. But it's not always practical for many of our farms out there who don't live in that New Zealand type climate. So that brings me to the next one. If you can't control the climate and graze pasture on hand, you can control how much fodder you store, or to a more extent, how much homegrown feed you have. Now, interesting again, I've split that graph up into average years and drought years for Southern New South Wales, and split it up into Northern New South Wales. This just shows the Southern New South Wales, and Northern New South Wales was very similar to this, and I can send that around later. But what we see for the homegrown feed percentage of the diet versus our EBIT is that there's no correlation at all in an average year. And there is, to an extent, a correlation in those drought years, but it is quite low at just 0.06, so 6%. So while there's no definitive correlation, we do know that leaving yourself open to market does increase the business risk. Now, if we look at the lower end of this group, some of the lower performing farms also have the lower amount of feed of homegrown feed in the diet, demonstrating the risks that these businesses carry if they don't have those fodder reserves to use the market. This demonstrates the risk carried by pushing a system with low homegrown feed, and it also demonstrates a lack of evidence of there being any reward for operating down this end of the scale, because it's not geared towards more profitable farms in the average years. So again, we can conclude that homegrown feed does not necessarily make you more profitable, but it gives you a lot more certainty during drought and much greater flexibility on your cash flow. Now, I'm going to stress that it is very difficult or almost impossible for some farms to increase that homegrown feed percentage of the diet during drought. It's just not an option. But this is more about looking forward to those good years. And the cash flow will be a lot more stronger if you can draw on that feed inventory. Now, where's that feed inventory come from? We can look at strategically purchasing fodder on the market as a very valid option as well for farmers to build their feed inventory. So many of the farmers in the project, their cost actually exceeds the market at certain times of year for hay and silage. This graph just shows the grazed cost per tonne dry matter for New South Wales farms in blue. In dark green, you can see fodder purchased on the market, and conserved feed is that light green. And you can see that conserved and fodder purchase actually track quite closely together until the last 3 years. So there was a lot of opportunity to buy on the market at around the costs, the costs that it would cost you to make that fodder. Now, for the last 3 years, if farmers had purchased hay on the market in 2018, they would have avoided a near 50% increase in the average hay prices between years at spot prices. And hindsight's a great thing, but again, if we do look forward to those good years, if we see a sustained recovery, this really shouldn't matter because money in the bank at the minute is receiving close to 0%. So unless you have an alternate investment out there, purchasing fodder on the market when prices are low or building that homegrown feed storage over time is a very valid management practice to avoid those consecutive years of cash constraint during drought. Now, the last one I'm going to talk about is our high production system. And I'm sure everyone out there would have seen or would have heard of the phrase dilution is the solution. And another one I often see is the push for production with the assumption that it will dilute your costs. So how does our production systems correlate with profit? Well, not very well. As demonstrated here, there's a slight trend in the average years towards lower concentrates being more profitable for southern New South Wales, but no correlation at all in the past 3 years, and none at all for northern New South Wales either. And this graph shows the boarding concentrates of tonnes of dry matter per cow versus our EBIT on the left-hand side. And the takeaway from this graph really is that there's not a strong correlation either way. Now, if we take this and look at this production per cow, which is our kilograms of milk solids produced per cow on the bottom versus our EBIT for New South Wales, we start to get a slightly fuller story. And this is where the effectiveness of management also comes into play, because you not only have to feed those cows concentrates, but also convert this effectively. Now, we do have a cohort of farms that are producing lower production per cow that are seeing slightly lower results than the group. And I think this further demonstrates the point before that it is essential that if you do reduce feed costs, it can't be to the detriment of efficient production. But aside from this, it's pretty hard to draw any conclusions from the graph whatsoever. So the level of production or concentrates in the diet is not a profit driver in New South Wales. But there are some advantages and risks for this system that I want to talk about. And the first one is labour. So a common misconception is that a high production system can get away with a high cost of production. And we know from our primary profit driver of cost of production from that first graph that that's not correct. And this is where some of the benefits of a high production system can come into play if you get them right, meaning that cost of production can still be relatively low if costs are diluted effectively. Now, I've split this for New South Wales, the group, into 3 production systems. So we've got our high production plus 600 kilograms of milk solids per cow, our medium production, and our low production down the bottom. Now, in the middle column, you can see the cow's milk per labour unit is fairly similar across the board. There's no real difference either way. But when we look at our milk solids per labour unit, there is a significant increase to that high production system, almost a 20,000 milk solids per labour unit increase to our lower production systems. Now, why is this important? Well, labour efficiency is another one of these profit drivers under overhead costs that, if you do get it wrong, will significantly decrease your performance. So labour costs make up around a quarter of an average farm's cost of production. So it is a significant portion. Therefore, if you can dilute this effectively through high production, it can result in significant cost savings to the business. And it's worth saying that you can't expect to dilute your costs effectively if you are only utilising around 40 cows per labour unit. That's just simply not going to be possible. Now, some of the risks of the various intensive systems, and this is a great one of these, is that those little costs in these systems can become large costs very quickly. And when you're looking at tight margins, particularly over the last few years, this is very important. So we can see the plants and equipment percentage of total assets versus our, on the bottom axis, versus our depreciation costs per kilogram milk solids on the left-hand side for New South Wales. So we can see that we've got farms operating above 80 cents per kilogram milk solids of depreciation. So that overcapitalisation of these farms is costing them big time. And this is before you look at repairs and maintenance and finance costs on that equipment. So I think this is a great example that those little costs that you generally wouldn't spend too much time looking at, or might not spend too much time looking at, can suddenly inflate very quickly and can become a big cost driver in your business structure. So to wrap this systems talk up, who do I follow? And I'm sorry to disappoint, but I'm not going to back a system out of it because there's little to no evidence of a correlation between systems and profit drivers in New South Wales to back it up. But what I will say is, don't be like Izzy Folau here and go and play AFL when your skill set is playing league. Because as he demonstrated, code hopping can be a big failure for even the very best athletes out there. And you will be found out very quickly if you transition without developing the adequate skill set beforehand. So if you have access to cheap pasture the majority of the year, it's about maximizing that cheap source of feed and driving a low cost system. If you have a cropping background though and a runoff block, then maximize that crop performance and drive a lower cost supplement regime to maximize that profitable production. Now, to demonstrate the diversity of successful farmers in New South Wales, I've pulled out 8 farms from across the state who have made the conditions work for themselves over the last 3 years. Now, the last 2 farms are only in the project for the last 2 years, but I thought they were a pretty interesting contrast to one another. Now, each of these farms has been profitable on average, and each of them have done this in a unique way. So they've all taken advantage of the resources that they've had on hand. So as you can see, there's a huge range of systems that have achieved a high profit over the last 3 years, and some of the biggest contrasts I've highlighted in the group. So we've got a 2 milking cows per milking hectare stocking rate versus a full TMR versus a 4 cow per milking hectare stocking rate, 4.4. So we've got a massive range here. Our milk solids, we've got one farm actually producing double the amount of milk solids per cow than another one in our profitable farms group, but still both of them are achieving a profitable business. A grazed portion of the feed, again, full TMR farm, we've got a 31% of the grazed portion of the diet, which I would say is certainly getting along the lower end. And we've got almost 60% of the diet coming from that grazed feed, which is getting towards the higher end. And again, this is sort of reflected on the homegrown feed portion of the diet, all the way from 41% to almost 74% of the homegrown feed, or the feed source coming from homegrown feed as a percentage of the diet. And the last column just shows the differences in homegrown feed costs per tonne dry matter. I will say that generally most of the farms do it reasonably cheap. So, that first farm maximising their grazed portion of the diet has certainly achieved that in a cheap way at only $90 per tonne dry matter. And that TMR farm at $152 per tonne dry matter cut and carry. So we're obviously maximising that production or that cropping production as well. So just to bring this back to our main profit drivers, here's how our farms compare. Just one of the farms had a feed cost above the average for New South Wales. They did manage to make this up slightly in other areas of the business. And all other farms aside from this farm had lower feed costs per kilogram milk solids than the average of New South Wales. Cost of production was a similar story. So we've only got, we've got all of our farms but 3 with a lower cost of production per kilogram milk solids than the average. But interestingly, none of these were exceptionally high. So 2 of our farms were only on average, and one of our farms did have higher cost of production, but it was offset to some extent by their milk price. So it is important that they all had that under control over the last 3 years, and that was a key aspect of their business performance. So to bring this all together, I just want to have a couple of summary points. So we've just looked at 8 farms with different systems, and each have effectively exploited their resources that they had on hand, and they've all been profitable in different ways. Now, our profit drivers show us that to do this, though, we need to focus on constantly finding better, more efficient ways to use our resources, which is shown through our profit drivers. Now, the second point I'd like to make is stay within your skill set or expand it first. Now, there's plenty of studies out there that show around 20% of new businesses fail during the first 2 years and 45% fail during the first 5. So many new business owners dive in before they've developed the knowledge to deal with those business bumps along the way, and changing systems is effectively starting a new business. So it's important to develop that skill set or have trusted advisors in a support group that you can rely on. And remember that the grass is not necessarily greener over the other side, as shown through our systems relationship or lack of relationship with our earnings before interest and tax. Now, the last point I'd like to make is managing costs really is that key profit driver. Now, there's generally 3 to 4 farms in every farm monitor region in the project who are consistently in that top performing group. And I have interviewed many of them, and interestingly, not one of them say they've optimized this system. Every one of them is constantly searching for a more efficient way of setting up a business, a cheaper way to run things, or a more effective way to utilize their technology. So I'd certainly challenge anyone that say they can't improve their business performance, because that is one of the key criteria that these top performers always focus on. And under that, don't just cut your costs. It's about managing them. If you feed your cows poorly, they're not going to produce. If you don't invest in the business, efficiencies or the loss of efficiency will make it almost impossible to be profitable, which was shown in those profit drivers. Now, it's important to utilize that cheap homegrown feed. Grazed pasture is going to be the cheapest form of feed, but if it isn't an option, those maximising crop production can still reduce their cost of fodder to a point that it is well below the market. And if you can't, it's really important to build those feed reserves in cheap years. And remember, cash in the bank is earning you nothing, and those fodder reserves may save you half of your feed bill next drought. And the last point is just around those risks of various intensity systems. So those small costs can become big costs very quickly, and overcapitalization is certainly a big risk. So dilution can be the solution, but don't let it be to the expense of these other smaller areas. And that's what I'm going to end on. So happy to take any quick questions, and thank you all for having me today.
Thank you very much, Jake, for that presentation.